Hey, well, what's up, everybody? Glenn Hall here. Hope you're doing well. Hey, if you're a business owner or contractor or just curious about what it is that I do, like a lot of my clients are, hey, I need to ask you a question. When you buy a piece of equipment for your business, do you care about the upfront sticker price or do you care more about the total lifetime cost of owning it? You care more about the total lifetime cost, right? Well, today I'm going to talk about a comparison between different types of retirement accounts because every financial advisor tells business owners, max out your 401k or traditional IRA. The fees are low and you get a tax deduction today. What they don't tell you is the hidden partner sitting inside of your 401k waiting to take 20, 30, 40% of everything you've built. Today, in just a few minutes, I'm going to show you a side-by-side breakdown showing you how internal fees and indexed universal life policies stack up against taxes and fees inside of 401k or IRA. Hey, if you're watching live, drop on number 1, and if you're watching the replay, drop replay. So let's look at traditional account A, right? Your traditional 401k or IRA. On paper, the 401k looks cheap. You might pay a 0.5%, 1.5% in mutual fund expense ratios and administrative fees. Sounds pretty good, right? 1.5% annual. But here's how it actually works. You put money in pre-tax. You get a small tax write-off today. It grows tax deferred. You don't pay taxes on it while it's just sitting there. But the catch is on distribution day, when you retire at 60, 65 years old and start pulling out $100,000 a year to live on, 100% of that money is taxed as ordinary income at current tax rates. Here's the question nobody asks. Are taxes going to be higher or lower 10, 20, 30 years from now? Hey, with national debt the way it is, most business owners agree taxes are going up. So if you had $1 million in your 401k, that's not your $1 million. If you're in a 30% tax bracket, $300,000 of that belongs to Uncle Sam. You didn't just pay 1.5%. You paid 30% on all the taxes and growth inside of that account. Now, let's look at account B, right? A properly structured, max-funded, index universal life, or IUL policy. I'll be completely honest with you because I don't hide this, and IUL has higher fees up front than a 401k. In the early years, you got administrative fees, cost of insurance, premium expense. So yeah, the first couple of years, it's higher, right? But see, here's the thing. Inside of an IUL, you're paying for benefits, right? So the insurance company basically is assuming all the risk up front. So you're just you're paying that, kind of like you would with a mortgage. You pay higher interest rate because the bank wants to get whole, pretty soon. Right, so that's a lot of reason why the fees are more heavy up front, right? But in the later years, as your cash value accumulates, those internal insurance costs and the premium costs and those things, they drop dramatically as a percentage of the total wealth inside the policy. But here's where the magic happens. When you pull income out of a max-funded IUL retirement account or retirement supplement account, you do it through structured policy loans because it's accessed as a loan against your cash value. There's 0% tax, federal income tax, 0% state tax, no 1099 sent to the IRS. It does not trigger higher taxes on your Social Security. It does not affect student loan equations, and it cannot be accessed by creditors or litigation. And you have the death benefit. Most of the time, you have living benefits which if you're critically, chronically, or terminally diagnosed ill, then you get a percentage of that money upfront, tax-free cash, right? So here's a metaphor, right? Think about this like buying a building for your business. Option A, the 401k. You pay a tiny maintenance fee every year, but when you sell the property 30 years from now, the government takes 30% of the entire sale price. Option B, the IUL. You pay a little higher maintenance fee in the first few years, but when you sell that property, you keep 100% tax-free profit. So which building would you rather buy? If you're a business owner making good money, you're already likely getting hammered in taxes every April. Why build a retirement plan that sets you up for another massive tax bill later in life? Plus, unlike a 401k, IUL comes with a 0% floor. The market crashes tomorrow, your 401k loses 20%. Your IRA, your IUL loses 0%, right? Totally protected from market corrections, and your credited interest cannot be impacted either. So every business owner has different cash flows, different tax brackets, different goals. But if you want to see a side-by-side illustration, how that looks like for your specific age, income, business needs, and compare, the 401k to the taxes that are, inside of a 401k versus are not there in an IUL. Hey, drop the word legacy or DM me the word legacy, and I'll get right on it. We'll sit down and I'll do a custom illustration showing you your numbers. No pushy sales pitch, just math, right? So you can make the best decision for your business and for your family. Drop the word legacy and I'll reach out. Thanks for tuning in today. Stay safe. Keep building that legacy. And oh, by the way, probably next week I'll drop a video showing the fees inside of an IUL, so you know exactly what you're looking at on a percentage-wise rate. So anyway, drop the word legacy, and I'll be back in touch. You guys stay safe. Have a great day. Bye-bye.